Friends, in this video for ithought Advisor, I'm going to talk to you on the topic fast moving macros. When the macros change very fast, it doesn't end there. For example, when the rupee appreciates or when the rupee depreciates, there has to be a consequence. Now we are faced with the depreciation of the rupee and it's happening faster than we are used to. What we are seeing today is the rupee losing strength, FIIs selling continuously, the dollar index at all-time highs of 111, 112. This in turn is further pushing FII sales higher. That again puts more pressure on the rupee, and we are seeing this virtuous cycle playing out. Naturally, the market sentiment has weakened considerably over just a few trading sessions. We can always say that this is sympathetic to what is happening in the US, but we all know to a reasonable degree that the events in the US were expected. Most of us knew this was the course events would take. Actually, there are no surprises in the US for us. Inflation is just as we expected. Interest rates are going up more or less on predictable lines. We know the problem is not going to end anytime soon, so we will see the peak interest rates go to as high as 4.5% in the US or maybe even higher. Naturally, we will need to have a macroeconomic response to what happens in the US. While that response is probably being worked out, the stock market has already reacted. Always, the first to show a response will be the stock market, and it's showing weakness. Effectively, weakening of the rupee should help one set of industries, but we don't see strength in the stock prices of those industries because we are wondering whether the impact of the US economy going through a prolonged phase of economic turbulence would affect these companies. Exporting companies are already feeling the heat. Exports have considerably decelerated in August, so people are wondering how the season would be. Nobody is clear. In such a situation, markets tend to be more volatile and we are seeing that. But as an investor, what should you be doing? This is where active investing has a tremendous opportunity. When macros drive markets, it's not a good time for passive investing because if it's going to take longer to mend the macros, the passive investing is going to more or less track the macros. But if you're an active investor, there is a lot you can do. There is a lot of innovation you can bring into your investing. There are specific pockets where you can invest your money aggressively and seek opportunities actively. That means that the investor who is going to be focused on what he wants will get more than what he wants. And the investor who is just going with the flow will probably flow in the wrong direction because the markets may head in that direction. If macros are not reined in quickly, if domestic macros are allowed to take their own course and the RBI doesn't find the tools to fight, or the tools to make the depreciation of the rupee more moderated, then we could see panic rise even further. That's what fast moving macros do to the stock market. When that happens, should you panic or should you assume that the macros will eventually be fixed and that would be a good time to bet aggressively and actively on equity? History shows us that those of us who bet that the macros would get fixed benefited enormously by investing during those turbulent times. Turbulence would mean more volatility. I saw this lovely tweet by my friend Subra which says exactly that. So turbulence would mean more volatility, but that does not mean that you would have an investment accident. Because if you cross the turbulence sensibly and you land smoothly later, you are going to be happy that you reached your destination. When there is turbulence in the stock market, you must participate actively and then anticipate the end of turbulence. We are seeing the beginning of turbulence. We don't know how far this turbulence would go, but we certainly know that turbulence has its own way of going down and ending, and that end always meant advantage to the investor. So, happy investing and thank you for watching this video.